The silver market is out of control. We're using AI to get this information to you quickly. Check this out.
The Federal Reserve held interest rates steady at 5.25% to 5.5%. But what they said behind closed doors may matter more than the decision itself. Something has already shifted beneath the surface, visible in the U.S. 10-year Treasury yield hovering near 4.3%, signaling that markets are not fully convinced easing is coming soon. If you think the price of silver has an easy path ahead, then stay with me, because I am going to break down what is going on behind the closed doors. This type of hesitation does not normally persist unless liquidity conditions are tightening in ways policymakers are not publicly emphasizing. These silent tightening conditions tend to appear most clearly when silver becomes unstable, as shown by its violent 30% collapse from above $48 to near $34 in early February 2026, exposing how fragile leveraged positioning had become. Almost nobody is noticing that silver open interest still represents over 800 million ounces in futures exposure, meaning positioning risk remains structurally elevated. Stay with me, because I am going to show you why the Fed minutes matter far more than the headlines. The official rate decision reflects current policy, but the minutes reveal internal expectations. When policymakers express concern about inflation persistence, financial conditions, or premature easing, markets immediately adjust expectations for liquidity availability. That adjustment does not wait for policy action. It begins the moment participants believe easing may be delayed. During similar policy hesitation in 2022, the US dollar index surged above 114 and silver fell nearly 40% from its cycle highs, not because demand disappeared, but because liquidity tightened faster than expected. Silver is uniquely sensitive to liquidity expectations because it sits at the intersection of industrial demand and financial speculation. Unlike gold, which is primarily a reserve asset, silver futures trading volume frequently exceeds 600 million ounces per day, dwarfing physical production levels of roughly 850 million ounces annually. This imbalance means price is driven less by physical shortage and more by financial positioning. When the Fed signals prolonged restrictive policy, even subtly, it increases real yield expectations, which historically pressures leveraged silver exposure. The real danger is not rate hikes. It is delayed easing. Financial markets have spent months pricing in the probability of rate cuts beginning in 2026, and silver's recovery attempts reflect those expectations. But if the Fed minutes reveal hesitation, concerns about inflation, financial stability, or asset bubbles, those expectations will be pushed further out. Even a shift of 90 days in expected easing timelines can trigger liquidation across leveraged futures markets. That liquidation does not unfold gradually. It accelerates rapidly as margin pressure forces positioning adjustments. This is how silver moves, not slowly, but structurally. Financial conditions tighten before the public realizes it. Liquidity expectations shift before policy changes, and price reacts before the narrative catches up. The Fed minutes are not a summary of the past. They are a preview of the liquidity environment ahead. And right now, that environment is far less stable than it appears.